Hello and welcome to Switzer TV. I'm Peter Switzer, and today I'm talking to Sebastian Evans, who's Chief Investment Officer at NAOS Asset Management. Welcome, Sebastian.
Thanks for having me.
All right, tell us about NAOS and what you exactly do.
So we're a boutique investment manager, very sort of active portfolio management focused. We have two listed investment companies. One's NCC, focuses on the small cap, micro cap stocks, just has 11 positions. And then NAC, which is a mid cap offering, so anywhere between $300 million market cap up to the ASX 100.
Okay, so give us an insight into your unique investment strategy.
So we believe we're unique because, as I said, we're very much active. We believe in concentration is king, so we own 10 to 15 positions between our two LICs. And by that, we believe in very much a long-term value-driven investment approach. We don't believe so much in trading, sort of more speculative trading. We believe in undervalued businesses backed by excellent management teams and good balance sheets. And over the longer term, especially in a listed investment company structure, they will outperform significantly.
Okay, so how do you view the current global macro settings?
So surprisingly, as a very much a bottom-up portfolio manager, we tend not to pay a whole lot of, I suppose, attention to the macro environment, albeit it does it can have a significant...
Like a recession does get in the way.
Yeah, exactly, a recession. I've got to admit, I haven't been through one for many years.
Yeah.
But in saying that, I think if you look at sort of the macro backdrop and we look at a number of risk metrics, surprisingly, everyone does sort of remain relatively bearish, especially in Australia. But if you look at a lot of the macro indicators, they're very positive. Interest rates are low, inflation is slowly increasing. If you look at a lot of the debt markets, which we tend to look at, because they tend to be ahead of equity markets, they're very benign. And everyone's complaining about complacency, but it's been very complacent now for a number of years.
So you've mentioned the bond markets. How are you investing in a low interest rate environment?
I think at the end of the day, we try to keep it very simple. And I think you invest in companies that have the ability to grow earnings over a 3 to 5 year view. And unfortunately, I think in a low interest rate environment, you are waiting a lot longer for those gains. But I think it pays to be patient, in my view. So we're trying to find businesses that have the flexibility either to acquire or reinvest in their own business. And then over the time, that'll hopefully grow their earnings base and you'll get some multiple expansion and some capital growth.
The fact that we do live in a low interest rate environment, does that make you think that maybe you've got more time than you would if inflation was speeding up, interest rates were rising and the end of a bull market looks closer?
Yeah, no, exactly. I think, we've said it for a while now. It feels like the last 5 years, we're almost going through the same thing again, albeit, rates have the potential to increase over a 2 to 3 year period. But definitely in the environment domestically where we are today, you have the ability to be patient because the environment is relatively benign. How
do you actually select the company? You talk about having 10 or 11. Yeah. What is the most important criteria that you use to say this company has to be in our collection?
Yeah, so I think, above all, it's actually management teams. So when you're backing small to mid-cap companies, you tend to be backing 2 or 3 people who've sort of been there before and done it before. You're backing businesses that have excellent brands, they have a good revenue base, but they may not necessarily be profitable, believe it or not, because that creates the opportunity. And the balance sheets allow them to either, as I said, reinvest into their business, reinvest for growth, acquire businesses, and it gives them the flexibility to fall back on themselves if things tend to take longer. But we always believe in brand, people and balance sheet, and then over time the earnings will look after themselves. Can
you give us an idea of a classic company that fits the bill? I don't know, give us the 10, but just give us one that says, NAOS has given this company the thumbs up.
Yeah, look, I think it's, you put me on the spot, but I mean, a good example would be a business. You look at, I'll give you maybe 2 examples. The business is called Enero Group. They're a PR business, advertising business. They own 5 agencies in Australia and also around the world. So they do a lot of marketing for Aldi, for example. Good revenue base, about $120 million. At the time of investment, margins were about 4% EBITDA. If you compare it to WPP, which is listed in Australia, their margins are circa 15 or 16%. Matt Melhuish, who runs that business, was a founder of an agency, a very successful agency. Has taken over that business, and over the journey, he's been able to grow the margins of that business. They've won a number of awards. They made their first acquisition in many years, and they have a net cash balance sheet of about 35 million on a market cap of 120 million. So if it does go a little bit pear-shaped, you know he's got the ability to reinvest, bunker down and go again. But there's some other good examples. An example that everyone would know of and be surprised by this is Billabong. You know, we've been watching that business for a long time. Big revenue base, $1 billion. I'm sure everyone's going to talk about Amazon. But at the end of the day, Billabong, they control their brand, they own their brand, they're vertically integrated. Margins are low, but they're in probably the 4th year now of a turnaround strategy, backed by an excellent management team that did, Eddie Bauer and a number of other turnarounds. But these things take long, and unfortunately, in today's equity markets, everyone's just so short term. No one's willing to be patient. Everyone's waiting for the next half year result as opposed to looking out. And many of our investments, we say they actually wish they probably weren't listed. They tend to be private as opposed to be listed on the ASX for those reasons.
Okay, so what keeps you awake at night?
Execution. I think, execution of the management teams that we invest in. Something always goes wrong, and when you're relying on a lot of other businesses that aren't necessarily listed, they don't have the same, I suppose, need for, to sign contracts immediately. They don't have the same time pressures, and it makes it hard. So execution is the biggest risk for all of our businesses. I think aside from that, everyone talks about some form of financial disruption or contagion again, but I think the way we look at it, we can't see that coming for at least 12 to 24 months.
And do you care where you invest, whether it be local or overseas?
So we're predominantly, today we're actually 90% Australian, and we're a big believer that our advantage is our information, and our information comes from meeting companies, meeting customers, meeting unlisted competitors, and to do that overseas in an efficient manner, an effective manner, is, in my view, it's extremely hard. And you need a significant amount of resources behind you to do that. So we're going to focus on the small to mid-cap space in Australia for now.
Okay, thanks for joining us.
Thanks for having me.
Very insightful. Well, that was Sebastian Evans, the CIO at NAOS Asset Management. I'm Peter Switzer. Thanks for joining us.